Assalamu alaikum. Welcome to lecture 22 of companies. This is the last lecture on companies because after this we are going to go to VAT from lecture 23 onwards. So this topic is family companies and related planning scenarios, where this will cover up the remaining portion of companies. So here we are going to focus on business vehicle, closed companies. This closed company chapter is a new chapter for ATX. Very likely that it will occur in your ATX. So be prepared for it. Extracting profit from a company. This is also a very popular question for your ATX exam. And personal service companies, withdrawing investment from a company, and summary. So business, individuals can have business or company. Okay, if it's an individual, it's sole trader or partnership. We have covered it. Unincorporated and partnership could be limited liability. For company, there could be personal service companies and other companies. Other companies, how do they extract profit and how do they withdraw the investment? And closed companies. So this lecture considers multitask scenario, multitask from business perspective, and introduces tax planning measures to minimize your tax liabilities. Much of the content of this lecture is covered in more detail in other lectures. That means whatever you are going to cover here, most of them, detailed part has been covered in other lectures. That's why before you come to this lecture, if you have missed out my previous lecture, you need to go back and watch my income tax, my CGT, my IHT, my corporation tax. Okay, that means all the previous 21 lecture, which you will get under ATX playlist. You can click the I button above, which is appearing on your screen, and directly you will be taken to my ATX playlist. Now, so this lecture aims to show how various taxes interact, and it forms the basis for a multi-tax scenario examination question. Remember, ATX is not just one tax. It focuses on interaction of multi-tax, VAT with income tax with CTT, VAT IST and CGT, income tax IST CGT VAT with corporation. It's a mix. So now, so areas covered in tax that are this. You have covered it in tax. Choosing the appropriate business when you are starting to trade, whether you go by sole trader or a company or a partnership. How do you extract profits from a company? So the new areas at ATX are this: closed companies, personal service companies, and exit strategies, such as you are purchasing your own shares and putting the company into liquidation. These are new in ATX. Okay, so now business vehicle. See, when an individual decides that they want to start a business, there are some factors that they need to consider. Okay, one factor is whether they want to directly own it, like sole trader, or if there is more than one person involved, it becomes a partnership. Alternative is they could set up a limited company. Okay, so the individuals involved will then be shareholders and directors of the company. Now remember, each method, why are we going through this business vehicle? Because they have their own tax implications. So these are the main areas that you need to consider. What amounts does the individual pay tax on? If you are an individual, you are a sole trader or a partnership, you will pay income tax. If you are a company, you will pay corporation tax. You see? Now, is there a liability to NIC? Remember, if you are a sole trader, you pay NIC, class 2, class 4. If you are an employee, class 1, class 1A. Remember the NIC chapters that I've covered while I was doing income tax? Yes. When is any tax payable? If you're a company, your tax dates are different. If you're an individual, your dates are different, due dates. Commercial consideration, some commercial reasons, business reasons. Next, so this is a very useful table for your revision of ATX when you want to know the difference between sole trader and company. This is a very good table. I've summarized it out for you, so you don't have to do all the hard work. Summary of differences. So when you are taxing the profit, Remember, sole trader are taxed under income tax rule. Okay, their trading profit will be taxed under income tax rule, but company will be paid a corporation tax on their TTP, total taxable profit, where we have profit with gains also. But this is after the individual has paid themselves a salary. Okay, for sole trader, second difference, when you are making a private use, when a sole trader is having a private use of an asset, you have to make an adjustment when you are calculating trading profit. For company, there are no adjustments for private use. Instead, individual will be taxed on any benefit received. Sole trader, they will get capital allowances. When their capital allowances are given for both company and sole trader. Difference is private use adjustments. For capital allowance calculation, for sole trader, there is a private use adjustments. For company, no private use adjustments. Full capital allowance is given. Personal allowance for sole trader, no personal allowance for company. Okay. But remember, individual will have a personal allowance to set against the income that they have extracted from the company. On that income, they can get personal allowance. Now, income tax at 20, 40, 45%. Company, corporation tax at 19% small profit rate, 25% main rate. Now, NICs, class 4 NIC, 9% on profits from 12,570 to 5270 and 2% thereafter. And class 2 NIC, which is 3.45 per week. There are no NIC for companies, only sole trader. So this is your basis of answer when you are told whether this beneficial tax implication for sole trader versus company. Next, relief for losses. Sole trader, they will get relief against total income. They will get relief against total profit. That means income and gains only. Next, opening year relief is there for sole trader. Okay. So loss in any of the first 4 tax years are set against the total income of 3 previous tax years on a FIFO basis, earliest year first. There is no opening year relief for company. Then for sole trader, there is a relief against total income of current and then previous tax year. This they can extend against chargeable gain in the same year. They can carry forward against the profit of the same trade. For companies, current year, remember current year, they can only set against the total profit. That means both total profit includes both income and gains of the current accounting period. For prior year, they can set against the previous 12 months. That also against income and gains. And they can carry forward against total profit, income and gains. Now, withdrawal of fund. Third difference. There are no tax implications for sole trader when you are withdrawing the fund. Why? Your profit has already been taxed as a trading profit. For company, you can take the fund as a salary or a bonus, okay, as an employment income. There are allowable deductions for companies. Employee class 1 NIC you have to pay. Employees class 1 NIC you have to pay. And if it's a dividend, you are taxed on a cash receipt basis. It is taxed as the dividend rates. First 1000 is covered by dividend rate band. Excess tax at 8.75, 33.75, 39.35. All this is covered in your income tax. This is just a revision. We are bringing forward whatever we have learned before. Dividend is not an allowable deduction from trading profit for a company. Okay. With this withdrawal of fund, usually is an area which is often tested. So be careful. Now, company must have a distributable profit for you to withdraw the fund. Otherwise, you can't. Next, VAT. Individual registers. If a sole trader, company registers. And disposal of business. There is a gain on individual chargeable assets. So gain are business assets. Okay. If the gain are on business assets, you get a gift holdover relief. You get a business asset disposal relief if you are disposing entire business. And IST, 100% business property relief on gift or legacy from IST perspective, inheritance tax when you are disposing a business. For company, there are gain on shares. Shares in an unquoted trading company are business assets, gift holdover relief if shares are gifted, business asset disposal relief or investors relief on disposal, IST 100% BPR on gift or legacy, same like sole trader. Now, so that is the difference. So these are the considerations when you are choosing the relevant structure. Intention to withdraw profits. See, if you are withdrawing profit, remember sole trader has to pay tax on the profits made, not the amounts drawn out of the business. But where it is not intended to withdraw all the profit, it is more advantageous to operate as a company rather than a sole trader. Why? Companies pay tax at a lower rate compared to a sole trader. Remember, sole trader's highest income tax is 40%, whereas companies paying tax either at 19 or 25%. Okay, so that means whatever the profit you are retaining will be taxed at the lower rate for a company if you are operating as a company. But in future, if you are extracting further fund, that will have further tax consequences, but that is something to be worried in the future. Okay, so if your intention is to retain fund, retain profit, not to withdraw all the profit from the company, better to operate as a company. If you want to take out all the profit, better to operate as a sole trader. That is the whole idea. Now, next consideration is initial losses. If the business will start with losses, it is better to structure it as a sole trader. Why? Because sole trader can utilize their losses against their total income. They can get the advantage of opening year loss relief. Opening year loss relief is not available for companies. Next, once the business becomes profitable, better to change it to a company, incorporate it as a company. Third consideration, liability. Where a liability is an issue, company is better. Why? Company has the status of limited liability, which sole trader does not have. But remember, some businesses are not allowed to incorporate, like LLP, limited liability partnership. So in this case, you can use LLP, limited liability partnership. Next, limited liability partnership. This is taxed in the same way as an unincorporated partnership, with each partner paying tax on their share of profit. So each partner's liability will be limited to their amount that they have invested in the partnership. But remember, there is no limit to the liability for work that the partner is personally responsible for. Now, this is the summary of the business vehicle. So when you're choosing the structure, see the liability, the loss relief, okay, tax liability, the NICs class 2 and 4 versus class 1 NIC. Class 2 and 4 you have to pay for your sole trader. Class 1 if you are a company, because you are giving benefits to the employees. Then capital taxes. Next, so sole trader, profits not drawing, and company structure. So income tax on salaries and dividends, corporation tax on profits, and these are the capital taxes. Business asset disposal, asset relief you might get, then investors relief and gift holder relief, and 100% BPR for IST. Now, moving on to the next, which is new, closed companies. What is the definition of a closed company? It is owner managed businesses. Okay, so owner managed businesses will be closed companies, where owner is the one who is managing the business. So a closed company is a company controlled by any number of directors or 5 or fewer participators. Control means having more than 50% of the issue share capital, voting power, right to receive distributable profit, or right to receive the net asset in the event of winding up. Now, a participator is a shareholder. To decide whether the group has control of the company, you have to see the shares of the associates also. This also you have to include with it. So associates could be your spouse, your civil partner, children, parent, remote ancestor, brother, sister, business partner. You have to take their shares as well. Now, a company which is a subsidiary takes its status from the parent company. So if the parent company of a group is a closed company, remember subsidiary is also a closed company, because subsidiary and parent are associated of each other, they are related. If the parent is not a closed company, subsidiary also will not be a closed company, even if it is 100% owned subsidiary. Remember, parent's company status will go to the subsidiary company because they are associates. Same like that, associates will take the status of each other. Now for your exam, okay, you have to identify, okay, you may be required to identify that a company is closed. You have to identify. Company might sometimes, question might not tell you directly whether the company is closed or not. You might have to read the case study and identify whether the company is closed or not. Therefore, you need to be able to spot a closed company scenario even if you're not told there is one. This could be tricky. Now let us do a question. Test your understanding. 1. Explain whether or not La Family Limited is a closed company. So you have been given some shares. Okay, Janet 12, Arthur her husband, Louis her son, Sarah's cousin, and Hugo is unconnected, the only director. So you can see they are 12, 6, 5, 20, and this is 7, 20. Felicity unconnected 4, and 24 other shares, each with 2%. So tell me, if you see, it's just 20%. None of them are having above 50, right? So the company is not controlled by the director. If you see, Hugo is the only director, but Hugo only has 20% shares. Okay, but if it was controlled by 5 or fewer, okay, so we'll see we have to add the associates. Okay, that means with Janet 12%, we'll add her husband is an associate 6, and Louis son 5. So 12, 6 and 5 adds up to 23%. You have to take Hugo 20. Okay, next we are taking Janet's cousin 5 and Felicity 4. So if we're adding up all the 4, it adds up to 52. Okay, so if you see, these are the 4 largest shareholders. So they are owning more than 50%. So if you see, because they're at 52, they are owning more than 50. But other shareholders, if you see, they're each owning only 2%. There are 24 shareholders and total is 48. 2 into 24. But they are having 52, more than 50%. So because they have a control, these are the 4 largest shareholders. Remember, it has to be 5 or fewer shareholders. If it's controlled by 5 or fewer than 5, if it's controlled by 5 or fewer than 5 shareholders, it's a closed company. So this one is hold. So these are the 4 largest shareholders. If you see, you are taking Janice and the associate. Arthur and Louis are associate. Then Janice's cousin is not an associate. Hugo facility. So 1, 2, 3 and 4. These 3 are added together. So these are the 4 shareholders. Together they are having 52. More than 50. They are having the control. And it's 5 or fewer. So because they are having more, this is a closed company. This is the conclusion. It's a closed company. Okay. But remember, if the shareholders were unconnected, company then will not be a closed company. Why? As the 5 largest shareholders would only hold 48%. How? Take this 20. You have to take only this. If you take this 5, you only can take 5 or fewer than 5. So the max is 5. You can't exceed 5. you have to add the 5 shareholders percentage and see whether it is exceeding 50 or not for you to decide whether it's a closed company or not. But since they are connected now, they are associated with each other, you can take them together as one shareholder. Janet's husband and son as one shareholder. Janet's cousin is another one. The only director Hugo is another one, and Felicity is another one. So 4 shareholders, right? But if they were unconnected, Janet will be a separate shareholder, Arthur will be a separate shareholder, Louis will be another one, Celit will be another one, and Hugo. These are the largest shareholders. We are not talking Felicity because they are just having 4%. So this 5 if we are adding, they are just having 48%. There is no control. So if these 5 largest shareholders we are taking, and if they were unconnected shareholders, they already hold 48%. Therefore, then it will not be a closed company. Okay. Now, implications of a closed company status. In a closed company, shareholders who may also be directors may have a significant influence over company's resources and decisions. So, there are anti-avoidance measures in place to prevent the shareholders benefiting unfairly from their significant influence over the closed company. These are the principal measures. So, it covers the provision of benefits to shareholders, the provision of loans to or from shareholders. So, these are the 2 principal measures we are going to cover. In considering the measure, status of the individual must be identified. Individual may be shareholder only, or individual may be both shareholder and an employee or a director. Now, provision of benefits to shareholders, the first one. So, the provision of benefit to an individual who is an employee or a director is subject to employment income provisions. We have done this while I was doing employment income. I think it was around lecture 2 or 3. So, for the company, the cost of providing the benefit is an allowable expense. You can deduct it from your trading profit, the company, because you are giving this benefit to the employees. For individual, it is taxed. The benefit, whatever they are receiving, it is a taxable benefit under employment income. Now, so the tax implications for the company and the individual shareholder, okay, who is not an employee or a director, are as follows. Okay. Now, the company is deemed to have paid a dividend. There is no need for the company to have sufficient distributable profit, as a provision of benefit is not a genuine dividend. To give benefit, you don't have to have enough profit, because it is just deemed as a dividend. Okay. You are not actually giving a genuine dividend. For individual, there is, if the individual is the shareholder, okay, provision of benefits to shareholders. There is no if shareholders receiving this benefit from the company, there is no employment income that is charged. Okay. Next, the amount of the dividend is determined using the benefit rules. Value will be determined using the benefit rules, whatever the benefit it is. This I've covered when I was going through employment benefit. For shareholder, the value of the benefit will be treated as a dividend. For company, no trading profit deduction for the cost of providing that benefit, as it is treated as a dividend. For shareholder, this will be taxed in the year the benefit is provided. First 1,000, see, they are receiving it as a dividend. That's why first 1,000 of dividend income, 0%, because it is covered by nil rate band. Excess is taxed at 8.75, 33.75, 39.375, depending on what band it is falling into. Now let us do a question. Test your understanding too. Explain the tax implications for the company and the individuals of the provision of the company costs. Okay, here it's about Abdullah and Habiba. They are the shareholders of a company which is a closed company. Abdullah is also a director of the company. So director means employee. Now, company provide each of them during the current accounting period with a new petrol engine company car. List price is 20,000, emission is 101, they travel 5,000 miles, 3,000 mileage is on company business. The company does not pay for the private petrol for either Abdullah or Habiba. Corporation is at 25. They both are high rate taxpayer. Okay, explain the tax implications. They just told tax. It could be income tax, CGT, IST, corporation. So now understand, when you are giving the company car to Abdullah, he's an employee who is receiving it. He's also a director as a shareholder. He's a director as well as a shareholder. Employee also shareholder. So they will have the following consequences. Remember, they are receiving the benefit. You have to calculate the benefit using what? The car benefit rule. From where did we study this car benefit rule? While I was explaining you income tax. Under income tax, when I was going through employment income, employment income lecture, please check under my ATX playlist. It is, I don't remember the lecture number. It might be my lecture 2 or 3, employment income. There I have gone through all the various types of benefits: car benefit, fuel benefit, van benefit, accommodation, job accommodation, various things are there. Under that, one was car benefit. So I'm not repeating it again. Assuming you know the knowledge, is a brought forward knowledge, I'm quickly going to go through the calculation of benefit. So for the car benefit, you need the percentage. See the rate. It's 101. It's a high emission car. So for high emission car, you need to do this calculation. Highest is 55. Okay. This is 101. You have to round it down to the nearest whole number. 100. So that's why it's 100 minus 55, because you have 55 was the highest in that, according to that table. You have to go through that table and into 1 divided by 5. Why 1 divided by 5? You have to divide it by 5. That's why. It's 100 minus 55. Always each one have to divide by 5. So divide by 5 or multiply by 1 over 5 is the same thing. Then always add with 16%. 16% is the highest. Okay. It's a petrol. So you add. And this is the percentage. So this percentage you add with the list price. List price is 20,000 and you get the percentage. So this is the car benefit, 5,000. This is your employment benefit. Now you are a higher rate taxpayer. Higher rate income tax is 40%. Okay. So this 5,000 you will pay at 40%. So your income tax is 2,000. Okay. Additional income tax for Abdullah is 2,000. And this will be collected through payee system by adjusting his tax code. There are no employees NIC payable on benefits. Employees do not pay. Employers pay that. Abdullah is an employee now receiving the benefit. So he does not have to pay any NIC that is payable for benefits that he has received. It was cash benefit. Abdullah would have to pay NIC. Now there is no employee NIC payable on benefits for Abdullah as an employee, as a director receiving this benefit. So first point is over, second point is over. Third one, for the company, you are giving a car. For them, there is a capital allowance available for that car. What is the list price? 20,000 of the car. At what rate? Remember, you have to see the CO2 emission. CO2 emission is 101. It is exceeding 50. That's why it is 6%. Special rate. It's not, it goes in the special rate pool, not in the main rate pool. So your WDA will be at 6%. At 6%, which is 1,200. And because it's a company, it's at 25%. So tax relief at, remember, capital allowance, you will get a tax relief. Why? Capital allowance you deduct from your trading profit. That's why it's a tax relief. Okay, so 25% on this 1,200 is 300. So your tax relief is at 300. That means your corporation tax will be reduced by 300 by this tax relief. Okay. Next. Remember, for company, they are liable to employers NIC. And each one is in different point, okay? So, because it's a benefit, it will go to which class? Class 1A. I've covered this while I was explaining you NIC. Do not forget. If you forgot, go back to my lecture and revisit and come back. Class car benefit, any benefit subject to class 1 NIC. How do you calculate 1 NIC? Simply, straightly 38.8% on that benefit. Okay? Company gets a tax relief for it. They can reduce it. So the class 1A charges, what is the benefit? Car benefit is 5,000. On this 5,000, 13.8. 13.8 is fixed. Class 1A NIC 690. And it's a company. So corporation tax is at 25. So 25 over 690 is 173. That means your corporation tax will be reduced by 173. Why? You can deduct. For companies, it's a deductible expense. Employers NIC, you can deduct as an expense from your operating profit. That's why your corporation tax will be reduced by 173. Now, so that is for if he was a director. Now, coming back to once again, provision of the company car to Habiba, who is not a director but who is a shareholder. He's not a director but a shareholder. Now you are giving it to Habiba. Remember, Abdullah was a director also, shareholder also, not an issue. We are following the director's rule, employee's rule. But if he's a director, if he's a shareholder only, not a director, and then the shareholder is receiving this benefit from the company, what happens? That table. So for Habiba, no taxable benefit because she is not an employee or a director. Simply benefit we have already calculated before, same. That benefit was 5,000. So she is deemed to be receiving a dividend of 5,000 from the company. And this will be taxed at the dividend rate. Okay. So first 1,000 is covered by dividend rate band. She is a high rate taxpayer, so it is at 33.75. The remaining 4,000 will be taxed at this. So this will be her income tax. And for Hungton, the company, no tax relief under capital allowance system. No tax relief because it is assumed to be a dividend. And dividend is deemed to be made. And next, what is the value of the dividend? Company, 25% tax, corporation tax on this 20,000. Why 20,000? Why 20,000? What is the car? The list price of the car was 20,000. So that means you are giving a dividend of 20,000. So 20,000 into 25 is 5,000. From the point of company. The next principle, provision of a loan to a shareholder. There are two things. Loan from company to shareholder, loan from shareholder to company. So now you are giving a loan to shareholder from a company. Okay. This is irrespective of the employment status, has the implications for the company. There is a tax charge of 33.75 of the amount of the loan. Okay. Because for the company, if you are giving a loan, it will be treated as you are giving a dividend. That is the dividend rate, 33.75. For the company, when they are giving a loan to shareholder, there is a tax charge. Now, so the loan includes the amounts owed to the company by the participator, including overdrawn directors' accounts, and also debt of the participator has been assigned to the company. This charge is paid at the same time as the corporation tax liability, either 9 months 1 day after the end of the accounting period, or the charge is built into the company's quarterly installment payment. Next, no tax is payable if the loan has been repaid before the 9 month and 1 day after the end of the accounting period. So that's why you have to always check the due date when the loan was repaid. When the tax, where the tax has been charged, it becomes repayable when the loan is repaid. Where the part of the loan is repaid, the same proportion of the tax is repayable. Next, the loan is written off. When the loan is written off also, it becomes repayable. So the company can reclaim the tax paid when the loan was made. There is no deduction for the write-off against the company's profit for corporation tax purpose. At this point, individual becomes liable for income tax and possibly NIC. You have to see below. If the individual is an employee, then class 1 employer's NIC will be payable, which will be an allowable deduction against the company's profit for corporation tax purpose. Now, as the tax charge will eventually get repaid to the company, it is a cash flow for the company. No tax is payable by the company where the loan fulfills 3 requirements. First requirement, amount of the loan is less than or equal to 15,000 and individual is a full-time working employee, and individual including associates interest owns 5% of the shares or less. If these 3 conditions are there, no tax will be payable by the company when you are giving the loan. Next, so for the company's part we finished. Now for the shareholder, there is no immediate tax implications when they are receiving this loan from the company. Okay, if the loan is written off, individual will then become subject to income tax on the amount written off, as though it was a dividend received at the date of write-off. So what are you doing? Class 1 employee NIC will also be due on the write-off in the shareholder. Write-off in the shareholder is also an employee. Okay. Now, interest. Remember, with loan comes interest. Okay. What about the interest part? Where the company does not charge interest at the official rate. Official rate is 2.25%. Okay. There it's a taxable benefit. So the rules of the benefits will apply. We have covered this in an underemployment income, where you are giving a interest-free loan. So now, for an employee, this benefit will be taxed as earnings. Where the individual is not an employee, that means you are the shareholder, benefit will be treated as a dividend distribution. The next, provision of loans from shareholders to the closed company. Before this, let us do a question. Test your understanding 3. Explain the tax implications for both White Limited and its employees Sally and Claire of the loans made by the company. So Sally and Claire are both shareholders and full-time employees also in a closed company. They are not a large company for quarterly installment preparing accounts to 31st March. Sally owns 15%, Claire owns 3%. They are not connected with each other. Company lends each of them 12,000 on 6th April. Claire repairs 4,000 on 31st December. Interest 1.5% is charged on the loan. Ignore NIC. So now, first let us go through 3 things. What are those 3 questions? In fact, 4 questions. Is the amount less than or equal to 15,000? For both, it's yes. What is the amount of the loan? 12,000. Okay, it's 12,000. It's less than 15,000. Second, is the individual full-time working employee? Yes, both are employees. Does the individual owns 5% or less of the shares? Sally, no. Claire, yes. So therefore, is the loan caught by the closed company provision? This one is no, because it's all 3 are yes, that's why it's no. But for the Sally, because he's owning more than 5%, yes. So for Sally, we'll see. He's receiving a interest also at lower rate. Okay, so she's receiving a benefit of a low interest loan, and this will fall under the employment income. She's an employee also, so we'll calculate the benefit. Amount of the loan is 12,000. Difference of the 2 interests, official rate is 2.25 and interest being charged on Sally is 1.5. so this is the benefit 90. Okay, Now, so because the loan is caught by the provision, because she has more than 5% of the company's share, White Limited will pay tax. How much? 33.75 on this 12,000 loan, which is this much, 40/50 on this date. Why? 9 months 1 day from 31st March 2024. If you take 9 months 1 day, it's 1st Jan 2025. They are not large company, they are paying 9 months 1 day. It's corporation tax, okay? White Limited will pay corporation tax. So if any part of the loan is repaid before this date, tax charge is reduced accordingly. Okay. Now, Sally's part is over. Coming to Claire. Claire is not caught by the close company provision, but still employment income she is receiving. So now we'll use the benefit of employment income. How? Remember, she is repaying also, Claire. Okay, you see here, she repays 4,000 on this date, before that date, Claire. So now we go by the average method, 12 and 8,000. How 8,000? From 12,000, if you are repaying 4,000, you are left with 8,000. So at the end, the balance is 8,000. So 12 and 8 divided by 2 is 10,000. On this 10,000, charge the official rate, which is 225, and interest actually paid. So on this 12,000, you are paying 1.5 for 9 months and this for 3 months only. On the 8,000, 1.5, because you are repaying 4,000. Okay. See, look at the date. You are repaying it 31st December. Okay. So Jan, Feb and March of 2024. This 3 months. It's 8,000. The remaining 9 months is on 12,000. So you deduct that interest paid from interest on average loan, and this is the loan benefit. Okay. Here they might elect for the precise method if the benefit is lower. Okay. So in this case, HMRC have the right to impose the precise method, but would only do so if repayment pattern was not commercial or designed to reduce the benefit. This does not appear to be case here. In this case, precise method or average method does not give a big difference. So any method is fine. The next, provision of loan from shareholders to closed company. So shareholder may take out a personal loan in order to make a loan to or buy shares in a closed company. Income tax relief on interest paid on such borrowing is available as a relief deducted from total income, provided the company is not a closed investment company. You have to see below. Now, the conditions are that the individual has a material interest more than 5%, or is a full-time officer or an employee involved in the management of the company. The maximum deduction allowed from total income includes this type of qualifying interest. Remember I think in lecture 1 or 2, when I was going through the qualifying interest that you can deduct from total income, there were 4 conditions. Out of this was one relating to closed companies. That time I told you, when we come to closed company, you will understand better. Now maybe when you go back to that lecture, you can recall what does it mean. Okay, closed investment holding company, CIC. So all closed companies are closed investment companies unless their main activity is trading or letting property to unconnected person. The tax consequences of CIC are as follows. They have to pay corporation tax at 25%, whatever the profit is. Shares will not be treated as business assets for IST nor CGT, that means for inheritance tax nor for capital gain tax. Shares are what? Normally business asset. But if it's a closed investment company, your shares will not be a business asset for your inheritance tax also, nor for your capital gain tax also. This is only for closed investment holding company, by the way. The shares in this. Tax relief will also not be available to an individual for the money borrowed to invest in a CIC. Next. So the summary is this. Benefits to employee, normal rules. If it's not an employee, it is treated as a distribution. Like if you are giving it to a shareholder. So individual will be liable to income tax as if a dividend has been received, and no tax relief for the company on the cost of providing that benefit. Now, summary of loans. From shareholder to company, from company to shareholder. If you are giving from shareholder to company, there is an income tax relief for interest paid. Okay. If own 5% of shares of full-time employee, provided company is not a closed investment company. If it's from company to shareholder, company must pay 33.75% into loan with its corporation tax liability, and the charge is excluded if full-time own not more than 5% of shares and loan is not greater than 15,000. And company must pay 33.75 into loan, but if the loan is repaid before the due date, no tax payable. If the loan is repaid after the tax due, charge is repaid on the due date for period in which loan is repaid. If the loan is written off, company reclaims the tax paid, no corporation tax deduction for write-off, and individual is taxed on the amount written off as a dividend. Next, closed investment company summary. All closed companies, unless they are into trading or letting property to third parties, they are closed investment company. Now, so the corporation tax will be at main rate, shares are not business assets, and there is no income tax relief for the loan from shareholder for closed investment company. Now, extracting profit from a company. Next, many UK companies are small trading companies, and mostly consideration is how to extract profit in such a way that is very tax efficient, whether to extract it in a form of income or a capital. This is a very famous question for ATX. Okay, because when you extract profit, it has an implications for both the company and the shareholder or the director. Now, so this table will help you to answer whether to extract the profit from a company as a salary or a dividend. Why? Because this question is a very famous question for your ATX. Rates of IT, rates of income tax. For salary, it is at non-savings rate 20, 40, 45%. If it's dividend, it is 0. First 1000 it is 0. Then 8.75, 33.75 and 39.375. But if you see, the highest rate is in salary 40%, whereas dividend the highest rate is 39.35. So better in terms of income tax, better to take as a dividend rather than salary. Next, NIC is paid by individual. If you are taking the profit as a salary, you have to pay class 1 NIC on the salary at 12% and 2% based on the level, threshold level. For dividend, there is no NIC payable on dividend. Again, from the point of NIC, dividend is better. NIC is paid by company. For salary company, they have to pay, employer must pay class 1 NIC at 13.8%. And they will also get a 5% NIC employment allowance where the director is not the sole employee. Okay, earning over 9,100. Dividend, no NIC is payable on dividends by companies. Again, from the third point also, dividend is better. Now, corporation tax implications for companies. If they are giving salary paid to employee and NIC is paid by the company, they are treated as staff costs. You can reduce this from your trading profit. That means your corporation tax will reduce further. Whatever salary you are giving to your employee, whatever NICs you are paying for that employee, company can reduce this from their trading profit. But for dividend, that advantage is not there. You can't reduce it. It's not deductible. Therefore, in terms of the fourth one, Corporation tax implications for company, salary is better. Now pension contribution. Salary, remember, for pension it's good because it is treated as earned income. You can extend your basic rate band, higher rate band if you are making pension contribution. And it is also taken as a relevant earnings for your pension tax relief purpose. But for dividend are not considered as earned income. They are not even relevant earnings for pension tax relief purpose. Again, from the point of pension contribution, salary is better. Formalities. If you are taking a bonus at the end of accounting period, it must be paid within 9 months of the end of the accounting period, and you have to comply with IS 37. IS 37 is provision, contingent asset and contingent liability. And for dividend, company must have a distributable profit to be able to pay that dividend. Okay. So now let us do a question on this extracting profits. Test your understanding for. You have to calculate Norman's, the amount Norman will receive after all taxes. See, it says all taxes has been paid. And the overall tax cost of an additional profit extraction. So Norman is the oldest shareholder and the employee director of a company, paid a salary of 52, decided there are 50,000 of profits before corporation tax that can either be used to pay a bonus or a dividend. The 50,000 is to include any employers and NIC liability. Corporation tax is at 25%. So now let us go through the solutions. If you see here, we'll divide it into salary and dividend. So profit, let's take this 50,000. Okay, we'll see the impact if it's a salary versus dividend. So you can do it in a column of format like this, simultaneously one next to each other. You don't have to do the calculation twice. This saves a lot of time. Okay, so in your exam, when you have to do 2 things or 3 things parallelly with each other, you can show like this, 1 and 2 or 3 or 4, whatever, how many columns. Here there are just 2 things, salary versus dividend. So profit, take 50,000 as salary, take 50,000 as dividend. Now if it's a salary, what dividend, whatever is your dividend will be your TTP, pay 25% corporation tax, and this is the profit available if dividend is paid. And if it's a salary, okay, remember this 50,000, they say it includes employees NIC as well. So NIC is at 13.8%. Employers NIC. Okay. So now take that out of this 50,000. That 50,000 is a benefit. So because it's a benefit, on that 50,000, NIC's on a benefit is 13.8%. Okay, that's why. So now 13.8 over 113.8 into 50,000. You have to take this out. That's how you got this salary. With this salary, you have included this employees NIC and you got this 50,000 as salary. Okay. Remember, for company, you can deduct the amount of salary, the benefit that you have given. You can deduct both employees NIC, you can deduct the salary also from the profit. You can deduct. Okay. This is company, this is corporation tax, this profit 50 and 50 as a salary and a dividend. But salary that you have paid and employees NIC that you have paid from company's profit, you can deduct. That's why we are deducting the entire 50,000 here. So you are left with 0 TTP, 0 corporation tax. Okay, this is for company. In this case, the 5,000 NIC employment allowance is not available. Why? Nominee is the sole employee earning over this much, 9,100. Okay. Okay. Next. Now let us go to the normal. Okay, you have to understand at what rate. Nominee is a high rate taxpayer. How do you know that? She have already received a salary of 52,000. You have to see this information here. Already he has a salary of 52,000. Based on this they have given you to decide your rate. Okay, income tax level. So it's more than 37,500, right? More than the basic rate. Therefore, he's a high rate taxpayer. So this you have to do. Remember, this break up you have to do, because they have told in this para this 50,000 is to include any employer's NIC liability. Salary is usually at class 1 NIC, but in this one it's a benefit. That's why you are taking 13.8. You have to take this out and you have to take this salary. On this salary you are going to pay income tax, not 50,000. So that's why we are taking this salary here out. Dividend is here 37,500. This profit is available if dividend is paid. Okay, so you will be left with this dividend. Now you have to pay the income tax. Higher rate, so this rate will go at 40%. This out of 37,500, 1,000, and remaining 36 at higher rate. And you have to pay class 1 NIC at 2%. This is above the basic rate, 2%. So this you have to add with the class 1 NIC. Okay, when you are doing salary, but no class 1 NIC if it's a dividend. So now you get your net after tax income for normal. There is a note to this. What is it? This you can get through an alternative calculation. I will show you the alternative calculation as well. Then it's up to you to decide in your exam what method you want to use. So now salary. Okay, see, this is the salary, right? Now after tax you deduct this is your income tax. So you deduct this 18 from 43, and this will be your net after tax income. And same for dividend, this you reduce from 37,500 and you get this amount. Okay, that's what the question told you, right? Find the overall tax cost of the additional profit extension and amount Norman will receive after all taxes has been paid. After all means NIC, income tax, and whatever, corporation tax, everything. Now let's go to the alternative calculation. You don't have to do 2 calculations in your exam, please. This is only for your understanding that there are another method of doing this as well. So now this is a much quicker method. In your exam this is suggested, this method is recommended. So because they told after tax, whenever they say after tax, after scenario, it could be done in much quicker way by using the margin method. You can use the marginal rate of tax, the differences. How do you do that? So you are getting an additional salary, right? This additional salary, this will be taxed at 42%. Why? Higher rate income tax is 40 and you are a higher rate means NIC will be 2%. So 40 and 2, 42. So you will be taxed at 42. That means after tax you are left with 58%, the balance. So this one isn't this and this the same, right? But this method, if you see, this method is very long, lengthy, takes a lot of time, but this is very quick. Even by using shortcut you will still get full marks, remember. Next, for dividend. So additional dividend in excess of first 1,000 will be taxed at this rate. Okay, so just 100 minus this rate, therefore they will receive this much after tax plus 1,000. You have to add 1,000 because 1,000 will be taxed as 0. So just take 36,500, take the 1,000 out and after tax and take, and with that add 1,000. So it's 25,1 is the same thing. Okay, now other possibilities. There are other possible ways of extracting profit. They are You can charge rent, you can charge interest, and you can fund a pension scheme. So now rent. Where the property is to be bought for the use of the company, it may be preferable to consider owning it personally and charging the company rent for its use. The rent then will be an allowable deduction for corporation tax, providing it was at no more than a commercial rent. When the individual retires, the property may be sold with the shares or could be retained so that the rent received would supplement the individual's pension scheme. Now, there is a further advantage of direct ownership, is that if the company owns the asset, there will be two charges to tax before the individual receives the proceed of the sale of the property. 1. Company pays corporation tax on any gain. 2. Individual will then be taxable when the profits are extracted from the company. There is a slight drawback of holding the property outside the company. What is it? Is that inheritance tax becomes an issue. Why? Because then your business property relief is only available at 50%. But if the business is sold before the individual dies, then it will not be a problem. If there was a concern about a charge, insurance could be taken to cover any liability that may arise on death. Further, on the disposal of the property, it would not qualify for business asset disposal relief, even if sold at the same time as the disposal of the company shares. Why? Because associated disposal rules do not apply when you are charging a market rent, where a market rent is charged to the company by the individual for the use of the asset. You have to go back and recall the rule of the associated disposal rule. Right? Next, interest. Next, we are extracting profit is as an interest. So where the company has lent money to the company, interest may be paid by the company to the individual. The rate applied cannot be in excess of commercial rate. There's a timing advantage, as the company can deduct this interest on an accrual basis, but the individual is not taxed until it is received. For company, interest is deducted on an accrual basis, but for individual, it will not be taxed. That interest will not be taxed until it is received. Consider a company having a year end at 31st March. So interest can be acquired within the accounts for that period, but providing it is not paid until 6th April 2024. Then it will only be taxed on the individual in the tax year 24-25. Next, individual will be taxed on the interest received at 20, 40, 45%. Okay, in excess of your savings income nil rate band. And the savings income nil rate band is 1000 for basic rate, 500 for higher rate, and 0 for additional rate taxpayer. Now, where the individual and company are connected, interest must be paid within 12 months of the end of the accounting period to be allowable as a deduction for the period in which it is occurred. If it is not, then it becomes allowable deduction for corporation tax when it is paid. Next, pension contribution. When a company can make a contribution to a pension scheme on behalf of the individual, providing they fall within the approved limits, there would be no income tax or NIC liability. The main drawback of this method of extraction is what? Pension fund you cannot access until you reach 55 years of age. So this is summary is going to help you a lot. So type of payment: salary, liable to income tax. Okay, next we have dividend, we have rent, interest, and pension. If it's a salary, yes, you are liable to income tax. Yes, you are liable to class 1 NIC. Pension income, yes, it's a pensionable income. Corporation tax deductible, yes. Providing paid within 9 months of the end of the accounting period. You have to pay that salary within 9 months of the end of the accounting period. Then only you can deduct from corporation tax. Dividend, yes, it's liable to income tax. NIC, no, it's not a pension contribution and you can't deduct from corporation tax. Rent, yes, liable to income tax, no NIC, not a pensionable income. Yes. If you are giving the rent at commercial rate, you can deduct from your corporation tax. Interest, yes. Liable to income tax. NIC, no, not a pensional income. Yes, you can deduct it from your corporation tax provided it is not greater than commercial rate and you are paying it less than 12 months of the end of accounting period. And you have to pay it also. Pension contribution, not liable to income tax. No class 1 NIC. It's not a pensionable income. When you are paying the pension contribution, that time you can deduct from your corporation tax. Now, next subtopic, personal service company, PSC. What is the purpose of this legislation? This also is an area that could be tested, so be prepared for this. The purpose of this is to counter the practice of tax avoidance which are becoming widespread. So the reference is sometimes made to this rule as off payroll working or IR 35, which is the name of the original HMRC press release issued that set out the objectives of the legislation. So the schemes that the legislation aims to combat are as follows. See, many business, what do? They are reluctant to pay individuals for their services. Okay. Many businesses have been reluctant to pay individuals for their services directly as a self-employed individual. Because if HMRC reclassify them as employees, there's a cost and penalty incurred by both the self-employed and the business employing their services, that is the client. So as a result, what happened? Individuals who are self-employed, they are now encouraged to set up a company. With that company, client will contact with. Okay, client will have a contact with that company and pay the company for the individual services. That means you are a self-employed giving your service to a client, but you are operating as a company through a company. You are not working as a self-employed. You are showing that you are a company where the client is paying a company. If you are paying, see, if the client is paying a company, it's more difficult to say that the individual was a employee of that client. In short, what are you? You are an employee of the client, no? You are giving services to a client as per the client requirement. You are an employee of the client, but you are showing you are working through a company. So if you are doing through a company and giving service to your client, it's more difficult to prove you are an employee. Okay, so as a result, now companies have encouraged the existing employees to resign, set up a company, and the client would then use their services through that company, resulting in a major saving of NIC for that client. So you are going to save NIC. So the company owned by the individual worker is referred to as a personal service company. This individual workers who is owning that company is known as personal service company. Now, so individual realize that operating through a company is advantageous as follows. First advantage, the PCS invoices for the individual services plus VAT if appropriate. And so the client pays the invoice gross without having to apply their payee regulations. If you're an employee, you have to go through pay system, no? Your salary are paid through payee. Already your income tax is deducted from your salary and it's then net payment is given to you. But if the client is giving you, you are receiving the gross amount, nothing being deducted at source. Next, no employer's NIC payable. Next benefit, if you are a company, your profit will only be taxed either at 19 or 25%. Okay. So PSC pays at that rate. Now, third advantage. So you are an individual, right? The individual is an employee of the, you are an employee of the PSC, personal service company, or a director. You could be a director of the company, but without a contract of employment. thereby sidestepping the national minimum wage regulation. You don't have to follow the national minimum wage regulation also, because you are not under the contract of employment, but you are the only director. Fourth advantage, individual could draw sufficient remuneration, whatever the amount of remuneration you can draw as a director's fee. Okay, and this can exit the lower earning limit for NIC purpose, thereby creating entitlement to benefits. Next, but below the primary threshold so that no class 1 NIC liability arise. Individual can draw out the rest of the profit of the business as dividend. Next advantage, there is a scope for dividing the shareholding of the PSC with a spouse. You can divide it. So the two basic rate band could be utilized. Before, high rate income tax is charged. Sixth advantage, income could be rolled up definitely net of 19 or 25% of corporation tax charge, so that good and bad years can even out, and individual need never pay higher rate tax unless the individual so chooses. Okay, that means whether it's a good and bad year, it will keep rolling up and you will be paying, you will never have to pay at high rate tax. So as a result of such schemes, HMRC has introduced rules to combat this, because for them, they are losing on tax, they are losing on NIC. So what makes a company PSC? This diagram will help you. You don't have to draw diagrams in ATX, okay? No one will ask you. Just understanding is enough. Here, what is happening? Shareholder. Okay? Shareholder is having a personal service company. Okay? So through a personal service company, they are hiring worker. The shareholder is the worker actually. Through a personal service company, shareholder becomes the worker, and then they are charging a fee to the client. Client is giving a fee to whom? Not to the shareholder directly, to the personal service company, because worker is giving service to the client. So here HMRC will look at the relationship between the client and the worker. HMRC will ask these questions. Okay? If the company was not there, would the worker be an employee of the client or self-employed? This question HMRC will ask. So the normal rules for deciding employment or self-employment are used. If the situation is considered to be one of employment, the company owned by the worker is a PSC and the special legislation applies. If you are an employee, so the company that you are owning as a PSC, then special legislation will apply. There are different rules depending on whether the client is small or not, and both set of rules are covered separately below. If the client is small, rules are different. If clients are not small, rules are different. Now, so it is the responsibility of all medium or large private sector client to determine whether the worker is deemed to be an employee. Who has to do it? Whose responsibility? Client's responsibility. They have to determine whether the worker is their employee or not, and whether they are caught by the PSC rule or not. By contrast, it is the responsibility of the PSC to determine this and apply the rules if the services are provided to a small client. If it's a small client, responsibility falls on PSC. Okay. So for PSC purpose, in your exam, they will tell you what is the size of the client, big or small or medium. Okay. Both set of rules only apply if individual has an interest of at least 5% in the company. Okay. Or an entitlement to receive payment from the company other than salary in respect of services provided to the client. So if you are in such a position, that means you are entitled to receive a payment from the company because you are giving some services, not only salary, and you are having more than 5% interest. Only then these rules will apply. What rules? Whether to determine you are an employee of PSC or not. The client. The PSC is an employee of a client or not. Now, so services provided via PSC to a small organization. For services provided to a small client, only relevant engagements will be caught by the rules. Relevant engagements. Okay. That means these are contracts between the company and the client, which would have been a contract of employment in the absence of PSC. So it is the responsibility of PSC to determine whether any of these engagements are relevant engagements or not. Remember, although the client of the PSC is a significant beneficiary of the abuse, they are not the focus of the provision. Who is going to be abused? The client, no? But they are not the focus of this provision. So the PSC has to do all these things. Number 1, treat the income from that relevant engagement arising in a tax year as if it were paid out as a salary to the employee. This is only for small client, okay? And you have to account for notional income tax, not income tax, notional income tax. Remember this word. You need it. When PSC is there, notional income tax will come. Account for notional income tax and NIC on 19th April following the end of the tax year. Which date? 19 April. Then this notional salary is deemed to be paid at the end of the tax year. Now the notional salary. So the notional salary is what? Income from the relevant engagements. It is reduced by the following. Any actual salary you are receiving, it will be deducted from this notional salary. See, all these are deductions, okay, from your notional salary. Any actual salary and benefits received in the year, any expenses incurred by the company, which would have been deductible under the employment income rules, contributions made by the company to an occupational pension scheme, employers' NIC paid during the year on actual salary and on notional salary, 5% of the gross payment from relevant engagement as a flat rate deduction. Flat rate, simply deduct. To cover such things as overhead and training, it is not possible to deduct the actual expenses instead, whether or not the money is spent. Whether you spend the money or not, actual amount you can deduct. So just take the 5% flat rate reduction. We have a pro forma for it. This pro forma will help you. This is often tested if you are given personal service company to calculate what? Notional salary. So this is the pro forma for notional salary calculation. Amount received in the tax year from relevant engagements known as XA. From this deduct 5%. Then employees NIC paid by PSC, pension contribution by PSC, salary paid by PSC, allowable expenses, all this you deduct and you get XB. XB is your deemed salary, including the deems employers NIC. PSS deems employees NIC that you have to take out. So PSS employees NIC always into XB into 13.8 divided by 113.8. It's fixed. And you get a notional salary. This pro forma you have to remember. Now, the 5,000 employment allowance, if it's available, cannot be used to offset any employee's NIC arising on notional salary. It could be on your actual salary but not notional salary. So to avoid a double charge to tax, the notional salary and NIC are allowable for calculating corporation tax profit. You can deduct it from your corporation tax. Next, if you are paying dividend out of this income, they are ignored as part of the individual's taxable income. Now, summary for services provided via a PSC to small organization. Does the worker, so this will help you. Does the worker have an employee type relationship with the client? No. Normal rules apply to company profits and extraction of profits by shareholder. Yes, company is a PSC. Deemed salary calculation is required based on the tax year. Then this one. Okay, deemed salary. Next, tax due at 19th April following and deemed paid 5th April at the end of tax year. Next, no tax on dividend paid from this profit. Now, services provided via PSC to a medium or large organization. Before we move on to large organization, let us do a question on small organization. Test your understanding 5. So you have to calculate the deemed employment income arising from relevant engagement and the income tax and employees NIC. Next, calculate corporation tax by the company, assuming personal service company legislation applies. So here, it's a consulting trading company to a personal service company, only director employee, owns all the shares, occupied full time. It's a small organization. Wilson paid 70,000, did not receive any other income and drew a salary of 25. Taxpayer pay and employees NIC, this one were paid. So now let us draw the deemed employment income. What should you do? Notional salary. They are asking you the notional salary. Notional salary. So first, from 70,000 straight you deduct 5%, and you get this, and your salary, actual salary you deduct, employees NIC has been paid, you deduct, you get your deemed salary. It is including employees NIC, take it out and you deduct and you get your deemed employment income. Once you get it, calculate income tax. So remember, there is a basic rate. Your salary is 25,000. Basic rate is 37,700. Still 12,570 is left. This 12,570, what is it? Personal allowance. You have to deduct your personal allowance. Do not forget to deduct from your 25,000 salary. This 25,000 salary we are talking about, not 34,540. Because we want to know what is the basic rate band remaining. So take it and you get it, and this is the basic rate band remaining. That's why we tax that at 20 and the balance out of 34, the balance at 40, and you get your income tax. Okay, now coming to B, corporation tax. So this is your trading profit, the 70,000. Okay, that's your trading profit. From there you can deduct the staff costs. It's allowable. Staff cost is 25,000 salary and your NIC already paid. Then IR35 cost, 34,540. What is this 34,540? It is this deemed employment income. This you can deduct, and also this 4766. This 4766. This, it comes under IR35 cost. This also you can deduct from your trading profit, and you get your TTP and tax at what rate? 19%, because this TTP 3,500 is below 50,000 limit. So this is 665 is your corporation tax. So now, when a medium or a large client engages with PSC, responsibility of the client to determine the status of the individual worker. Okay, now if the client determines that PSC rules should apply, they are required to calculate and pay the income tax and NIC on the deemed direct payment, DTP. DTP is calculated like this. So if it's a medium or large, it's DTP. If it's small organization, it's a notional salary. Okay, so payment in respect of services net of VAT, less direct cost of material incurred by PSC, deductible employee expenses incurred by PSC, and deemed direct payment. Now, in order to avoid double taxation, DTP is deducted from any payment made by PSC to the worker, such as salary, before calculating income tax and NIC on that payment. Let us do a question. Test your understanding 6. Calculate the deemed direct payment arising from the relevant engagement. So here, all this is introduction, that they are small or medium and it falls with the PSC rules and all. will directly go to the payment. Invoice 20,000, it's VAT exclusive, and expenditure is 500. So here it is simply 20,000 minus 500, 19,500. This is your DTP. Okay, so this DTP will be subject to income tax, employees, NIC, and employers NIC, three things. Okay, so this income tax, employee NIC, employees NIC would be calculated in the same way as if the company was a direct employee of the Place PLC. So that's it. Now, withdrawing investment from a company, another subtopic. Where a shareholder wishes to withdraw their investment from a company, there are a number of exit strategies. So now we are moving on through the exit strategy of a shareholder from a company. Shareholder could sell their shares. They could purchase the shares back from the shareholder. Company could put it into liquidation. We'll go through all the steps in detail. In your exam, if you're asked a question on this area, it could be any one of these three. They will not ask all the three together. It could either be selling shares, it could either be purchasing back shares, or liquidation. Now, liquidation is the new one in this topic, ATX. So selling of share. This is not always easy in practical world, okay? Because there is not always ready market for shares, especially if it's an unquoted company. Okay? And also you can only sell it to the other shareholders with the permission. You need a permission of them to sell shares. You just can't sell your shares the way you want. You need the shareholders of other. You need the permission of other shareholders when you want to sell it to a third party. Okay, if the shares are sold, you have to consider the main tax to consider will be what? Capital gain tax. Selling of shares, capital gain tax, CGT, and also the availability of business asset disposal relief. More shares in an unquoted trading company will be qualifying asset if the individual was a full-time employee or a director of the company. Therefore, if the shares were owned for at least 2 years, business asset disposal relief will apply. Okay, now what about investors relief? One more relief we went through. So investors relief also might be available when you're disposing share, but shares must be held for 3 years after 6 April 2016, and shareholder cannot be an employee before the shares are sold. It may be possible to pay a dividend. Okay, then this will reduce your value of shares on the sale. Okay, so to decide if this is worthwhile, you have to consider the tax rates that apply to the amounts received by the shareholder when you're selling shares. So dividends are taxed at 0%. First 1,000 is taxed at 0, then 8.75, 33.75, and 39.35. Depending on the shareholders, what level he's a rate, whether he's a basic, higher, or additional rate taxpayer. Now, where a business asset disposal relief or an investor's relief, one of them, okay, is relevant, ignoring annual exempt amount, okay, CGT will be payable at 10% on the first 1 million, and if it's an investor relief, then on first 10 million. Okay, after the relevant threshold, it will be at 20%. Okay, at 10 or 20%. If you're having any remaining gain at the basic rate, it will be taxed at 10%. After that, it will be taxed, gain will be taxed at 20%. Therefore, a basic rate taxpayer, if you are a basic rate taxpayer, you may benefit from a dividend being paid before the shares are sold. But if you are a higher or an additional rate taxpayer and you are having dividend in excess of 1,000, you will not get the benefit of paying dividend before paying shares. Before selling shares. Okay. Now, purchasing of own share, the next method. This is new for ATX. So purchasing of own share and liquidation could be asked, not selling of share. Selling of share might not be asked in ATX, not very likely. But purchase of own shares or liquidation, the third one, high chance. Where it is not possible to sell the shares to another person, it is possible for them to be bought by the company. How? Purchasing own shares. So depending on how the transaction is structured, the amount received for the shares will be treated as an income distribution. The shares that you are receiving will be treated as an income distribution for you, a dividend or a capital payment. One of this. The income distribution will trigger a tax liability if you are having a dividend in excess of 1,000. Okay. If you are having a business asset disposal relief, better to structure it as a capital disposal, because your capital gain will be taxed at 10%, which is lower than the dividend rates. Now, there are some conditions for treatment as a CGT disposal. Some conditions are there that you need to meet for it to be treated as a CGT disposal rather than dividend. This condition could be asked in ATX. Make sure that you go through all these conditions. First condition. Company must be an unquoted trading company. Companies quoted on AMI are treated as unquoted. If you are AMI, unquoted. Shareholder must be resident in UK. The shares must be owned by the shareholder for at least 5 years. It's fifth, but it's 5. Okay. Shares has to be owned by the shareholder for at least 5 years. And if you are inheriting it, then 3 years you have to own it, including the ownership of the deceased person. If you are inheriting it, let's say you are inheriting it for 2 years, it was there in the hands of deceased person for 1 year, so 2 plus 1, 3. That 3 will be there counted. Okay. If acquired from a spouse, combined length of ownership is considered. If you are taking it from the spouse's ownership and your ownership together, it's combined and taken as 3 years. Now, fourth condition. Shareholder must either dispose their entire interest in the company, or interest must be substantially reduced. Substantially. This means the shareholders' percentage shareholding after the repurchase does not exceed 75% of the previous percentage holding. Okay. Shareholders' percentage shareholding after the repurchase does not exceed 75% of the shareholders' previous percentage holding. It cannot exceed 75% of the shareholders' previous percentage holding. Fifth condition. Shareholder must not immediately after the purchase be connected with the company. That means you are not able to control the company. You should not have more than 30%. You should not have greater than 30% of the voting power. Next, sixth condition. The purchase must be for the benefit of the trade and not a part of scheme to avoid tax. For example, you are buying out retiring directors. You are buying out disruptive shareholder. A shareholder has died and beneficiaries do not want the shares. A venture capital is withdrawing investment. It should not be this. Okay. Now, if any of the above provision, if any one, not all condition, if any of the above provisions do not apply, payment will be treated as distribution. That means as a dividend. It cannot be taken as a CGT disposal. Next, companies may seek HMRC clearance to ensure the capital treatment applied. They have to take the HMRC clearance from HMRC stating that this is capital treatment. You can use capital treatment. Note, taxpayer cannot choose which treatment is to apply. See, as a taxpayer, you cannot choose whether it should go as a capital treatment or a distribution. If the specified conditions are fulfilled, it must be treated as a capital disposal, and if it is not, it's an income distribution. Clear? Now, tax treatment. If it is treated as a capital disposal, normal CGT computations. And if it is treated as an income distribution, so the amount of the distribution is the excess of the payment over the amount originally subscribed for the share. If the member in the question was not the first shareholder of those shares, a capital loss will arise here. Okay, if the member in the question was not the first shareholder of those shares, a capital loss will arise here, calculated as the difference between the subscription price and the cost of the shares to them. Where the person whose shares are being purchased is a company, HMRC will always treat the event as a capital disposal. Remember, where the person whose shares are being purchased is a company, HMRC will treat it as a capital disposal always. Note, any legal cost and any expenditure incurred by the company in purchasing its own shares are not allowable against the company's profit for corporation tax. You can't deduct it. Legal cost and expenditure incurred by company to purchase own share, you can't deduct against the company profit for the purpose of corporation tax. Now let us do a question. Test your understanding 7. So in test your understanding 7, you have to set out the tax implications for Hamza if the income treatment applies, if the capital treatment applies. You have some information given to you. Okay, you have to act as a tax advisor for Bliss. This is the company and its managing director is Devi. Company has made tax adjusted trading profit 250 over the previous 5 years. Now, since this policy has not been to pay out any dividend, the company has not made any chargeable gain and prepares its accounts to 30th April. Devi informs you that he and Hamza, his fellow shareholder, are in serious disagreement about the future strategy of the company. Okay, now they decided Hamza should no longer be involved in the management of the company and the company will purchase all of the shares from him. So these are the relevant information that you need. Hamza has worked in the company as a full-time director since it was incorporated on this date. Okay, now it has acquired 10% for 3,000, 10% of the ordinary share. Hamza has a taxable employment income of 50,000 after deducting personal allowance. That means personal allowance has been deducted. Do not go back and deduct again. He has received no other income. Company has agreed to buy back Hamza's shares at market value of 600 on this date. All of the business assets are in use for the purpose of trade. Now, so first we'll go by the income treatment applies. Let me zoom this a bit for you. So now, if it's income, it will be treated as that Hamza is receiving a dividend and it will be subject to income tax at the dividend rates. Okay, now cash received. So how much? They are buying the shares at 600,000, isn't it? So now cash received is 600 less the original subscription price. What is the original subscription price? He acquired it for 3,000 from the first note. So 600 minus 3 is 597. Okay, it's a deemed dividend received. Now first 1,000 will be taxed as 0. Okay, then you need a note 2 for this. For the basic rate, you need how much is remaining in the basic rate band. Okay, so first let us go through the personal allowance. Even your personal allowance, we'll go through this one first. First we'll go through the note 2. Okay, so now if you see the higher rate limit is this much and first 1,000 is this much. What about the other taxable income? Do we have other taxable income? Note 1. You have to go through note 1 to see other taxable income. Okay, so the personal allowance will be restricted to nil as an adjusted net income exists this amount. Imagine if adjusted net income exists this amount, personal allowance is 0. Therefore other taxable income will increase by from this much to this much. How? From 12,570 to 62,570 by 50,000. And the loss of personal allowance will affect the total tax implications of the deemed dividend received. Wait, your personal allowance is 12,570. Okay, See, he has a taxable employment income of 50,000 after deducting his personal allowance, right? So because he has a personal allowance of 50,000, that 50,000 will be added with the personal allowance here. Okay, that's how you get 6 to 570 from 12,570. The difference is 50,000. That 50,000 employment. Okay, so the other taxable income is just 50,000. With this personal allowance, you are not getting this personal allowance. You are losing it, and you have employment income. So your taxable income will increase to this much. Since you are not getting any personal allowance, it will be reduced to nil. Okay. Now, so this is your other taxable income. Okay, so from your higher rate, if you deduct 1,000 and taxable income, you still have this much basic band left, right? 61,570. That's why it is taxed at 33.75, the basic rate, the next higher rate. Okay, so this one will fall in the higher rate, 597 minus the basic minus this 1,000. This will be taxed at the additional rate. Additional rate, not even higher rate, additional rate. Okay, you cannot utilize the basic rate band because you are falling in the higher rate. Okay, already other taxable income 62, it falls in the basic rate band. So whatever is remaining, this 61,570 falls in the additional higher rate, not in the basic rate, and this one 39.35 is the additional rate. Okay, you also have to add the loss of personal allowance along with it. Okay, so you are losing personal allowance of this much at what rate? At higher rate, 40%, not additional rate. Now the one is there, so you add it, and this is your total tax payable. When is it payable? This is income tax. You have to recall when you are paying the income tax. So this is the due date, 31st Jan 2025. Okay, now moving on to capital treatment. If it's a capital treatment, once again, sale proceed is 600, you bought it for 3,000. This is gain qualifying for this one. You will deduct your annual exempt amount. Do not forget the 6,000, and this is your taxable gain at what percent? At 10%, because it's eligible for BADR, and it will be 31st Jan 2025. If you see the due dates are same whether it's income or this one. Why will they get this? Very important, because Hamza owns at least 5%. See, 10% shares, right? So they own at least 5%. It's a trading company where he's worked. He has owned the shares for at least 2 years. If you see, that's why. So if you go by the capital treatment, what is the capital gain tax? 59,100. Whereas if it was income tax, it was 236,106. So if you treat it as a capital treatment, it's more beneficial because tax is less compared to income tax. So here you see they have got 10%, acquired 10%. Okay, full-time director means they have worked full-time, and it was incorporated. He has worked from 1st of June till the date he sold, so more than 2 years. So business asset, you will get the business asset disposal relief. Liquidation. So liquidation is the third way of withdrawing investment from a company. First one was selling shares, second one was purchasing back own shares, third is liquidation. Liquidation also has a very high chance of occurring in ATX. It's new. So most people associate liquidation with a company. Most people assume that if you are liquidating means the company has gone bankrupt. This is not always the case. Sometimes liquidation could be an effective way of extracting the final value of the company, where net assets of the company are worth more than the shares on a going concern basis, or no one wishes to buy the shares in the company as it stands. So the process of liquidation is as follows. Liquidator is appointed and the trade ceases. Assets of the companies are sold, outstanding debts are collected, and liabilities paid. There will be a corporation tax due on any profits and gains made on the disposal of the assets, and it must be paid. Liquidator pays out the balance of the fund to the shareholder and the shares are cancelled. Shareholders pay any tax due on the amounts received. If payments are made to the shareholders before the liquidity, this is very important now, whether the payments are made to the shareholder after the liquidator is appointed or before the liquidator is appointed. This is where you are going to be tested. If the payments are made to the shareholder before the liquidator is appointed, they are taxed as dividends. If payment is made after the liquidator is appointed, they are treated as capital receipt for the disposal of shares. Now, whichever of these two the taxpayer prefers will again depend on the taxpayer's income tax rate and CGT position. Now, before we move on to winding up, let us do a question. Last final question. So this is the last question on this lecture, that's on liquidation, test your understanding 8. Okay, you have to calculate the impact of extracting profit. 180 before the liquidation commences, with remaining 540 paid on this, the whole 720 paid out on this date. Okay, so you have been given the information. Simon is an unquoted trading company on this date, acquired 100% for 1000, always worked as a director, and liquidator was appointed on 1st of Jan 2024. So this other assets given 720 net asset. Okay, now Simon is an additional rate taxpayer and has realized substantial gains already in that tax year. Okay, now so option 1, pre-liquidation dividend. If it's a before the liquidator is appointed, it's a dividend. Okay, so 180 before liquidation commences. This 180, first 1000 will be taxed at 0, the remaining will be taxed at additional rate, not basic or higher. So this is your income tax. Now the remaining 540 proceed post liquidation is CGT. If it's post liquidation, it is CGT. So from 540 you deduct the cost. 1000 is the cost and it qualifies for BADR. That means it will be taxed at 10%. Why? And this is already used. How do you know? We are assuming it's already used here. Okay, because they have told substantial gains already. They have realized the substantial gains already in that tax year. That means we are assuming they have used the annual exempt amount. Okay, already they have used. Now there is a note to it. Here he has owned at least 5% of a trading company where he works, and he has owned the shares for at least 2 years. Okay, you see here 100% he has acquired. That's more than 5. He has worked for 2 years, more than 2. Okay, so that's the reason. Now, so this CGT payable you have to add with income, and this is your total tax payable. Option 1. Option 2, everything is CGT. So from 720 you deduct 1. This itself will be taxed at 10% because same will apply. So if you see, tax is low under this one, option 2, right? So now winding up. Cost of appointing and paying a liquidator can be high. When a business is profitable, it is possible to wind up the company without the formal appointment of a liquidator. HMRC will allow the payments made to the shareholders to be treated as capital, even though no liquidator has been appointed, providing company is being wound up and all liabilities are agreed and paid, including the individual's personal liability on any distribution by the company. If all the liabilities are paid, company is being wound up, then any payment received by the shareholder will be treated as capital. Next, total payment should not be more than 25,000. Okay. Now, if the payment is more than 25,000, the whole amount will be treated as distribution. That is income. So, a major element in the planning of a liquidation is deciding whether investment should be withdrawn in a form of income or capital. For an individual, so this will help you. For an individual who is a higher or an additional rate taxpayer, the capital is preferred. Why? Highest tax is 20%. And if the disposal qualifies for business asset disposal relief, highest tax is 10%. Whereas if it was taken as a dividend, as an income, highest tax is 33.75 and 39.35. It's very high. So if you are a basic rate taxpayer, dividend is better. If you are a higher or an additional, taking it as a capital is better. Now let us summarize this section: withdrawing investment from a company. 3 ways are there: sale of shares, purchasing own shares, and liquidation. When you are selling shares, it is capital gain tax. And if conditions are satisfied, that means you are having the share as a trading company, you are working there, you are owning for 2 years, having more than 5%, business asset disposal relief might be available. So it's always CGT, there is no issue. But in reality, this option is difficult because you might not get a ready market for unquoted shares. Second option, when you are purchasing own shares, if conditions, here condition has to be satisfied. If conditions are satisfied, it's a capital. There are 6 conditions. So 6 conditions, if it's satisfied, one of it, it's a capital disposal. Otherwise, it's distribution, income. Okay. So then it will be liable to CGT and business asset disposal relief. It might be eligible for it if conditions are satisfied. If conditions not satisfied, treated as dividend. Dividend is equals to whatever the amount that you have received less the net value of shares. Now, third, liquidation of company. Depends on payment before liquidator appointed, income, payment after liquidator appointed capital. HMRC allows winding up without a liquidator, and whatever the payment goes to the shareholder will be treated as capital if it is less than or equal to 25,000. If it's more than 25,000, all the amount will be gone as dividend, as an income distribution. Now, summarizing the whole lecture. So when you start a business, you can start as a sole trader, partnership, or company. It's your choice, but you have to see the tax implications. These are the main factors which will help you to decide whether to open as a sole trader or a company. Tax cost. You have to see from the point of tax what is most expensive. Sole trader, income tax, company, corporation tax. Okay, that table will help you, that I've gone through. NIC, income tax and all. Then NIC. Next is NIC. Okay, sole trader or partnership, they have to pay NIC class, different classes, and if it's a company, they are going to get a tax deduction. They are going to get a deduction for it. They can deduct the NIC payment from their trading profit. Next, payment dates. It varies for an individual versus company. This payment dates might help you in your tax planning. If you're having a cash flow issues now, you might defer the payment. Flexibility of a company on profit extraction. Company has a flexibility on how they want to extract the profit. They can either extract it as a dividend or as a salary. We have gone through that table, salary versus dividend. Based on that, you have to decide, and based on the case study. Next, limited liability. Company gets the status of limited liability. Sole trader has unlimited liability in the event of wounding up. It's an issue. Next, use of losses. Sole trader has some additional advantages. They have opening year loss relief, which company does not have. Now, so company chosen. Now, most owner managed companies are closed companies. We have gone through closed companies. They can extract profit as salary, dividend, rent, interest and capital. There's 5 ways. Now, you have to consider the tax rates once again. NIC cost, payment date, distributable profit. Same what you have considered for sole trader versus company. Next, PSC, personal service company. You have to calculate, rules to calculate the salary apply. You have to see whether the client is big or small. If it's small, notional salary. If it's big, deemed salary, right? Now, exit strategies, the 3 exit strategies: sale of shares, purchase of own shares and liquidation. We have gone through them. You have to see income versus capital and conditions apply. You have to see whether conditions are applicable or not. Especially for purchase of own shares and liquidation, there are conditions. Sale of shares is always capital, and you have to see whether reliefs are applicable. Business asset disposal relief is applicable or not. So that's it for this lecture. Thank you for watching, and with this I have finished the corporation tax completely. There are total 6 lectures under corporation tax. With this I have finished the 4 out of 5. I have finished 4 types of taxes: income tax, capital gain tax, inheritance tax, and corporation tax. The next 2 lectures, lecture 23 and 24, will be focusing on VAT, and then final lecture will be on ethics. Lecture 25 will be the last lecture. So 3 more lectures are remaining, and each day you will be getting the lectures. The remaining lectures will be coming up in the next 3 days, that is this week. That's Tuesday, Wednesday and Thursday. So by this Thursday, by 20th of November, all my ATX lectures will be uploaded. It's updated, it will be completed. All you have to do is, now since you have an overall idea of ATX, syllabus is almost over, 80% is over, I would say 90% rather is over. You have to open your revision kit and do the questions. Time yourself under the exam questions on your CV platform. You have to do it, and also some past papers, latest past papers that is given on your CV platform. You have to check out. At least I would recommend you to do 3 past papers. So I'm leaving you right here, and if you haven't subscribed to my channel, do subscribe to Sabia Akhtar and email me at accasabiakhtar@gmail.com for the ATX slides. Thank you and take care.